Sorry, guys. I'm trying to get my headphones hooked up for a second. Give me a second, man. Hold on. Press. I'm trying to figure out which headphones these are, man. I think these are my wife's. Okay, there they are. Connected. Connecting. Nope. I don't want those. Bro, where'd they go? Bear with me, guys. I'm sorry. I'm trying to get these right headphones set up. What's up, team? Hey, let me put the charts up here. I'm going to get my headphones set up, and while for the time being, I'm going to put my charts up now. There you go. All right, Tesla, NVIDIA, both kind of flat like we thought we would this morning. The FOMC decision's coming pretty soon here, guys. Again, market's very choppy. If there's one thing you can expect, I wonder what the accuracy would be like targeting the top of the range on choppy FOMC days, like ahead of the FOMC rate hike decision. It's almost always choppy, right? So wouldn't it make logical sense to short double tops heavier on days like today and long double bottoms heavier on days like today? Wouldn't that make much more sense? Like you go long around these lows, maybe you average in and you attack the range up to the top and then you sell or short back down to the bottom and then rinse and repeat back to the top. Since we know FOMC days are really choppy, I think that makes sense. Maybe it's a strategy. We'll work on building that up. And we still got an hour, so like theoretically we could attack it and test it out today, but you know, we'll see. Anyways, let me get my headphones working, man. I can't get my headphones working. Where'd my Bluetooth settings go? Bro, I like AirPods. But it was like, I'm using my wife's headphones because I don't know where mine went, and it disappeared. It said Carol's AirPods, and then they just freaking disappeared, bro. When I try to press the button, apparently this one doesn't freaking work. Ugh. All right, fully charged in there. All right. Okay, let's add Bluetooth. All right, I see my headphones. Oh. Maybe they're already paired. Yeah, I just don't see these. It's got to already be paired in here. Bluetooth, SoundLink, AirPods, Maddie's. Okay, did I get it? All right, let me test this out. I'm sorry, guys. Okay, there we go. Pair device. Yeah, of course we pair. Wait, where'd it go? Are we in here? AirPod Pros. Yes, pair device. Dang, bro. Okay. I'm gonna try this one more freaking time. And then I'm just gonna switch to these headphones right here. I got these headphones anyway. And so these probably got enough charge to last. I'm gonna have to switch them out before the press conference anyway. But there shouldn't be that many problems here. All right, look, AirPods. All right. Connect. Okay, boom, there we go. Connected voice music. All right, we're in here. Let's try it out. Apparently, the music I was playing earlier. Look at the Tesla chart rip up. I wonder if this is gonna drag the market back up. Here. Bro. There we go. Sheesh, dude, that was way too much work. All right. Took long enough, man. Spy not breaking 440. All right, team. What's up, guys? What's up, Randy? Jock. Type Jack. Gerd. AK. Unknown. Polaris. Reed. AC. Travelers. Robert. Biggie. Chris. Axe. Khalid. K. Siam. Mo. Z. Sosa. Norvin, Camp, Forex, Cy, what's up, team? Eli, normally bullish, but I'm bearish today. Hey, we'll see what happens. Again, markets pull it back. Part of me wants to short the top. If the SPY gets, again, I think it makes sense on major economic release days, maybe CPI, FOMC meetings, like whatever major economic release we got going on. Fed minutes report, whatever major economic report going on, maybe earnings days like Apple, Amazon, Nvidia earnings days. It makes plausible sense. It makes sense to short top of the range and then cover towards the bottom. Again, I don't know if it's going to work. I'm just throwing that out there. I think that makes sense. Again, we got a couple minutes until the actual decision. Rate hike decision is going to be at 2 p.m. They are overwhelmingly expecting a pause in rate hikes. Dow double top. Target's doing okay. Walmart's doing all right. Oracle doing okay. Honeywell still just paying me nicely. Gold coming back a little bit. Disney still moving up. American Express is down a little bit on it. AMC moving back up again some today too. Apple not looking that hot. With a pause of rate hike, I don't think it's going to make anything really pump. I think most of the market already expects a skip or a pause today. I think what's going to matter more is what Powell says during the interview, the Q&A press conference, what he says with regards to inflation expectations for the rest of this year, as well as rate hike expectations. If they come out saying they're going to be aggressive and they're going to raise more rates this year, I think that's going to cause a negative reaction to the downside. If they come out saying that we're probably not going to raise rates again this year, I think that's going to cause at least a small run up, most likely, but you never really know. And so I think that's the most likely outcome of those. Whether what Powell says in regards to recession expectations, like whether we're going to hit a recession this year, what we can expect moving forward for the rest of this year. Those are all like buzzwords and things to consider. Again, most people are expecting a pause or a skip. So if we come out skipping or pausing or whatever you want to call it, it's not going to be a shock. Now, with that said, there's a lot of time left, and we still got an hour or so before this report comes out. But yeah, we'll have to wait and see. Most people are expecting a pause. We'll do a poll real quick right now. But again, almost certainly we're going to get a pause or a skip. It's shocking how many people bet that we were going to raise rates today. I think that's wrong, but maybe I'm wrong. I don't know. Do you think the FOMC raises rates today? Yes or no? Vote on the poll. Poll is live. Let us know how you feel. Apple thinking of adding stock kind of trading to their phones. I can just imagine what kind of fees they will charge. Yeah, like Apple Finance. If everyone expects something, it usually does not happen. Wrong with rate hikes specifically. Maybe with directional moves like long term. If everybody expects the market to crash, the market goes up. Not with rate hikes though. Again, I cover every major rate hike decision, and most of the time, if everybody expects one specific rate hike, that's what we get. The Fed doesn't necessarily like to surprise people. And so, if everybody expects a rate hike for this FOMC decisions, it's pretty probable we're going to raise rates. Again, it's not completely for sure. It's not definitive, but it's still pretty likely, And again, maybe I'm wrong. Maybe we do raise rates today. I just don't think we do. I think it's fine if it's like 70-30 or 60-40 or 50-50 or whatever, that we could go one way or another. That's understandable. But when it's 99-1 skip or pause versus rate hikes, I think it's pretty unlikely. And I think if they do for whatever reason decide to raise rates today, it's gonna shock the system. Tesla push it up a little bit. Tesla at 269. So we can look at the Dow also. Like we can look at the Dow, the DJX, or where's the actual Dow? I guess I gotta look at futures. Or here's the Dow futures contract. Dow futures just broke 35K Can I look at Dow this way? Yeah, so here's the Dow Jones. Just looking /YM. I see the futures contract of it. The Dow currently at 35,000 roughly. SPY bouncing right off of that volume weighted average price. Again, we'll see if we get more choppiness. If my theory is correct, shorting up here and then riding it back down there would make sense today. Do you think that theory is correct? Again, I might be wrong, but that's kind of what, you know. Yeah, I feel you. 2 p.m. Eastern Standard Time, Joe, is when they announced. Yeah, Tesla ripping up big. It's dragging other broad market ETFs up. All right. I'm excited, man. It's been a while since we did a rate hike decision. I skipped going to jiu-jitsu today, so I'm still kind of bummed out I didn't go. Jiu-jitsu is addicting, though, man. It really is. Hey, yeah, thank you so much, Kay. Shout out to Kay for the donation, brother. Thank you so much, man. I appreciate it. Thanks so much. I see you always donating. You know, I appreciate it, man. Thank you so much. Hey, what's up, Han? All right, so we'll see if the SPY works out this way. Yeah, thanks for the $2, Randy. I'm just gonna avoid that question altogether, bro. But I appreciate the $2, sir. Thanks, man. But yeah, sorry, I'm just gonna avoid that question altogether. Tesla and Oracle show the site. Yeah, so again, I'm in Oracle right now too. I'm in Oracle right now. It's at 115s, 114s. I mean, so Oracle at 114s. We made some money on that one the last few days. John, if you zoom out on the Dow, you'll see what I mean. Let's see. All right, what are you saying up there, though? Let's see. Dow. What do you mean? Polaris. The Dow double top. How far out? I mean, here's a daily chart. What double top? I mean, you can consider a lot of this double tops, really. Depends on what time frame you're looking at. Here's a top up here. That's a far way away relative to where we are. Now we're right over 35K here. So the Dow, you know, depends on where you're considering. Dow's ripped up today. I mean, look at the market today. Dow's flown up, and that's relative to the rest of the market where it's pretty quiet. I think it invalidates your short the top on FOMC days theory. I mean, in what way? I mean, yeah, definitely on the Dow today. I guess that makes sense. Dow's flown up today. But I guess like the way I would have to look at it is like you can't just blindly short every broad market ETF and fund. I don't think it's like that. But I think when you get confirmation and stuff like this, right? Like, so essentially, I think if after the open you get price action like this, that's when you implement that theory, right? So you need something to confirm that theory first. I don't think you should just kind of blindly short these tops here or anything like that. I think you need confirmation in that choppiness. So you get up, down, up, down. Okay, well, hey, every time it starts to tap, you know, then it's more plausible that it's going to keep going like that. Again, I don't know. It's just a theory. I'm just throwing it out there. Hey, what's up, Kevin? We're going to almost certainly pause. If we don't pause, then, market's probably going to tank. Hey, thanks, Randy. Thanks for the dono, bro. Thanks so much, man. I'm short lift in Disney, long on UEC. Hey, good luck. I don't know what UEC is. Any news on why Tesla's ripping? Let me check it out. All right, Tesla was asked by U.S. lawmakers for details on their relationship with China CATL. National debt reaches $33 trillion. BYD outpaces Tesla 16-fold in patent filings. Tesla Australia partnered with CBA to streamline financing. So Tesla Australia and Tesla basically formed a partnership with the Commonwealth Bank of Australia, where the bank has basically been selected as the go-to finance provider for Tesla and other EV companies. So yeah, they did a deal with the Commonwealth Bank of Australia. Specifically, Tesla did. So that's probably why Tesla's pushing up. If you see Tesla up, Tesla broke over 270s, still up really nicely. It's kind of dragging the rest of the market up to a certain extent, but I mean, you guys remember to test the theory, we said, hey, if this starts to reject and come back down, then the theory could be confirmed. And I think that's exactly what you got here. You got choppiness confirmed. And then again, in that situation, you could, once we get like a certain amount, maybe like you could use the RSI for this. Once you get a certain amount under the RSI, ride it back up. I think that makes a lot of sense. But again, just kind of spitballing at, like throwing out ideas. I don't know. Yeah, I think the Cybertruck makes a lot of sense for police officers. It's bulletproof to a certain extent. It can go on water if it needs to. It floats on water, that is. I don't know if it can actually go on water. Yeah, I don't think it can. But it floats on water. It's bulletproof. It's fast. It's got decent towing capabilities. I think for a cop, that makes sense. Yeah, I mean, people don't need to donate, Randy. I mean, listen, bro, I make enough money. I really do. I mean, you can donate if you guys want to at home. I'm not gonna discourage it, but like, I'm not out here begging for it either. I appreciate it, but yeah. Feds need to put their focus on executives. Yeah, but that was so long ago. They're just gonna turn a blind eye to it. All right, so there's the SPY. Again, here's the NASDAQ. We had the Dow up earlier. NASDAQ's not really as choppy, though, as the SPY. And so I think one of the ideas could be isolate like a broad market ETF, like maybe the SPY or the Q. Find one that has confirmation and choppiness throughout the day on FOMC day or CPI day or big earnings days, and then just attack that choppy trend until it breaks. What is ICP? Yeah, except for the windows. NVIDIA falling back down, though, and I think NVIDIA is one to watch, especially with the rate hike decision today. I think NVIDIA is starting to fall back down. It's had a choppy couple days. Yesterday was slightly red, followed by a green day the day before, or maybe that's backwards, but yeah, choppy NVIDIA trend. Yeah, I mean, I know the insane clown posse and internet computer protocol. When will he talk, guys? He's going to talk at 2:30. I don't know how Disney's going to react to the rate hike decision. I don't know what the future of that is. I really don't. I don't know what the internet computer protocol. I don't know what it is. Or I know what it is, but I've heard of it before, but I don't know what the future of it is, to be honest. Do y'all like this music better than the music I played this morning? Yeah, Tesla's ripping up, Nvidia again falling down. We're at 271s here for Tesla, 271s. SPY still flat. We can watch the Q as well. The Q's a little bit more red today. All right, we got 61% saying no. We don't raise rates, which is probably, you know. If it was predicted for 2+ pauses 6 months ago, someone knows something that's being very quiet. Yeah, I mean, I remember 6 months ago when we had 4 rate hike decisions left, and they said that they were going to do 2 more rate hikes this year, which is 50% of the ultimately 50% of the rate hike decisions left. Now, that could change. Number one of the potential outcomes is that could change, and they could just, you know, skip the rest of the year rate hikes and keep it the same where it is now. Or they could do the planned skip or pause today and then raise rates in November and then do whatever they want to do in December. Or, you know, they can keep going back and forth. I think it's unlikely they raise rates today, but I think anything's possible with this. It's just, you know, with rate hike decisions like CPI is something that a lot of the time can go against the grain of expectations. FOMC decisions generally do not go against that grain. Look at Tesla rip. Tesla up to 273s. But FOMC decisions generally do not go against expectations. They're almost always what's expected. Now, it doesn't mean they can't, but it's just less likely. It's just not very probable. But again, I'm certainly not saying that they are absolutely going to skip today. It's just, again, it's just most likely what's going to happen. Yeah, I did. Thank you for reminding me, Pawn. Because I gotta set an alarm to right before. So let's see. So again, at 2:30. All right, look at Tesla up to 273s. Market's still flat, not really any real direction. And so I think days like today, in the SPY at least, it could be those days where you just kind of range trade. So like when we get really deep on the chart, you start adding buying long. When you get really up there over VWAP, you start adding short. When you dip down, you can kind of rinse and repeat that over and over again in whichever kind of style you want to do it. I think that makes a lot of sense. But again, it would be something where you need confirmation first. And again, today we are going to do the rate hike decision. Bearish or bullish FOMC, I'm not sure. ICP is the Internet Computer Protocol. It's basically like a crypto internet almost. Look at Tesla still running up, guys. And it's dragging the rest of the market up too. So look at the SPY. It's defined as it's an internet computer blockchain developed by Dfinity in 2015. It was created in Switzerland in October 2016, actually, to scale up their project's R&D. The foundation first raised funding through a public ICO in 2017. ICP is a blockchain network that aims to bring greater efficiency, speed, and decentralization to computation and data storage. It aims to address shortcomings associated with traditional internet, such as monopolization of services, poor system security, and misuse of personal data. End quote. And that is from the Kraken website. 40%. Yeah, I mean, that's 40% of my viewers, though. The Fed meeting is actually at 2:30. Any tips for a newbie who wants to get into the stock market? Don't try to get rich. Best advice I can give any new investor or trader: stop trying to be rich. Don't try to be rich. The problem with trying to be rich in the stock market is number one, it rushes. It's too much of a rush. You know, anybody that tells you they make 20% every day, or they make 5% a day every day, or they make 20% every week, or they make ridiculous percentages, they can make 2% a day. Anybody that tells you they make 2% every day is full of crap. You know, and they're going to try to sell you a course, to act like they're the greatest, sell you on their signal service, and they're going to get rich from nonsense. Okay. The reality of it is just take it slow, trade small. Don't try to get rich. Try to learn how to trade for the first year or two. And if you start to show success, great. Make sure your success isn't just from averaging into positions, and make sure your success is not just adding to losses, adding to losses until you win, because that'll work most of the time. But then when it finally doesn't work, you're going to destroy your account. And a lot of people are misled by their own systems, thinking they've got some crazy profitable system when they don't. So just paper trade small. Best advice I can give you. Yeah. Yeah, market's starting to really get tight range here. Again, you can see the SPY's range is really tightened up. So like, look, SPY's range is really tightened up. You know, really tight range. Hey man, can you go over scenarios related to the Fed decision? Sure. So, all right. So we'll go ahead and deep dive into this, right? So, okay, the Fed, their reason for raising, cutting, or pausing rates is all relative to what inflation looks like at that point in time in the economy. And their decisions, their plans do change from meeting to meeting or cycle to cycle. And it happens every 6 weeks, right? So every 6 weeks, the Fed meets to determine how much they want to raise, lower, or pause rates. And if inflation's really bad, right, the logic of rate hikes is that the more aggressive the rate hikes, the more short-term pain the market experiences, because when they raise rates, when they raise rates, it raises it. Okay, so when the federal funds rate is raised, it makes banking more expensive, right? It hurts the banks. And so when it hurts the banks and it makes banking more expensive, banks in turn raise interest rates to consumers. When that happens, consumers stop spending as much, and then businesses must lower their prices to compensate for that lack of spending because of initially what was started by the Fed raising rates, right? That's the cycle of it. With that, you know, if inflation's really bad, the logic of the Fed is that they're going to raise rates more aggressively, but up to a point. If they raise rates blindly too much, of course, it's going to cause really big short-term pain in markets, right? So the more the Fed raises rates, the more short-term pain the market experiences, but the more long-term inflation damage they're putting in. And so it's a balancing act where, you know, you don't want to just go crazy big and, you know, raise rates 100 basis points every time or something crazy, because before you know it, everything's going to be fried in markets, in the economy. And so instead, the Fed chooses generally to take like a slow and steady approach in which they slowly raise rates, you know, and they also take breaks in between their rate hikes. You know, like right now, like last time we raised rates 25 basis points, this next time we're probably going to pause today. So today we're probably going to pause or skip. But yeah, anyways, so with today, what we're expecting is a pause or skip, because last time we raised rates 25 basis points. And generally, you can look at websites like the CME tool or the CME Group Fed Watch tool like this, and you can see the probabilities of like different things. You can see how much, basically what's going to essentially happen. 99% of people think that we're going to pause or skip, and we're going to keep the federal funds rate from 525 to 550. All right, only 1% of people think we're going to raise rates 25 basis points. And you can see this is for the September meeting, which is today. We can also go to November and see, and for November, 73% roughly think we're going to pause, 27% roughly think we're going to skip, think we're going to raise, and then 0.3% think we're going to raise 50 basis points. But that's the logic of this, right? And it's all relative to inflation. You know, inflation data drops a couple different metrics each month. One of them, the one that I specifically watch and most retail traders watch, is called the Consumer Price Index. It's CPI. The other one the Fed chooses to watch is the personal consumption expenditure. It's called the PCE, the core PCE, which excludes food and energy. Anyways, with all that said, it's overwhelmingly expected that the Fed is going to pause or skip today. So basically 99% of people in banks and everybody else thinks that the Fed is going to skip or pause. They don't think the Fed is going to raise rates. And so what that means is, theoretically, if we pause or skip, then we should get a neutral reaction. But it's sometimes not that easy to predict. You know, a lot of people are already front loading into that specific decision because it's so overwhelmingly expected. So we don't really know what's going to happen if they announce the pause or skip. What's going to matter more than the decision that they make, is going to be what Jerome Powell says during the actual press conference, because everybody already expects a skip or a pause. Jerome Powell is going to give updates on what they think they're going to do moving forward for the rest of the year. You know, and there's a couple more rate hikes. They happen every 6 weeks. And so there's a couple more rate hikes this year. What we're expecting to do for the next future rate hikes this year is going to be a big influence over the market. And so if the Fed, for instance, says that they think we're going to be aggressive with rate hikes for the rest of this year, then the market's probably going to go down, because again, it's preparing itself for that lack of spending in markets. And vice versa, if the Fed comes out and says that they're looking to pause for the rest of the year, that they're going to be dovish, would mean that they're going to pause and not be aggressive with rate hikes, then the market might go up. It could also react the very opposite of what I'm saying. So it's never a given, and it's never that easy. And if it was, everybody would kind of be rich. But that's basically what it is. And so I guess the point is, if we come in as expected at a pause or a skip today, hang on to what Jerome Powell says, because that's what's going to be the biggest influence over the markets moving forward over the next 6 weeks period, aside from other stuff, of course. But that's going to be a big influence over the markets until November, when they raise rates again. We're also going to have the minutes report, which drops weeks after this report. So in a couple weeks from now, we're going to have what's called the Fed minutes report, which just details with a little bit more detail and why they chose to make the decision that they did today. But yeah, it's overwhelmingly expected that they're going to pause or skip today. All right, so nobody likes this music apparently. There we go. Yeah, pause would mean they're not expecting any more. A skip would insinuate that, or imply, I should say, that they're going to skip this one and then go back to rate hikes in the next one, right? That's the difference between skip and pause. It basically means no rate hike today, but one of them implies that they're going to raise rates the next 6 week cycle, which is a skip, like they're just skipping rate hikes this one, and the other one implies that they're going to have a continuous, sustained, pause in rate hikes, or in federal funds raising. Yeah, we'll see. All right, guys. Hey, we got 30 minutes. 30 minutes before the actual decision. We got 500 people here. Hit the subscribe button if you haven't already, guys. All right, NVIDIA all down to 432s. 432s. All right, so Microsoft and Meta lawsuit coming out. Who are they getting sued by? PayPal says PayPal US dollars now available in Venmo. GM says Kansas assembly plant is being idled Wednesday due to a UAW strike. Intel Granulate is adding autonomous orchestration capabilities for Databricks workloads, which will deliver an average of 30% cost reduction for Intel. Where's the meta? I'm looking at the meta news. Amazon says nearly 1 billion Alexa devices have been purchased. Microsoft and Adobe partner to deliver cost savings and business benefits. T-Mobile reportedly faces data breaches with users as well. Announced today. All right, guys. Yeah, the futures market, you could trade the E-mini, which is the S&P 500. You could day trade the NASDAQ. You could day trade currencies, gold, silver, no PDT restriction, a lot of access to leverage and funded account programs. And so futures are really nice. Most pro day traders trade futures because there's just better liquidity there than stocks. And again, I'm a person that went from trading the SPY pretty regularly over to trading futures. I mean, they're a little bit different, but, you know. All right, guys. Hey, y'all ready? Oh, all right. The Fed rate hike is today, guys. Today we got the Fed rate hike decision. Let me know what you guys think we're going to get. I'm ready. Hopefully we get some good stuff. Hopefully the Fed, my guess, what do you guys think this is going to come out? I think the Fed is going to come out a pause or skip. And then afterwards, they're going to be a little bit more bearish or hawkish during the actual press conference. That's my guess, pure guess. Have no idea what we're going to get. Do I think they raise today? No. Should they? 100% they should. The broader economy is already showing signs of stagflation. To not raise means higher for longer. Yeah, I tend to agree. I'm not necessarily against that. Yeah, it's unlikely they're going to hike today. Again, it's just very unlikely. I mean, could they? Yes. Will they? Probably not. Again, y'all have to understand. Like, and again, I know y'all are used to me covering economic reports, right? And so y'all are used to the expectation for CPI being 3.5% and then coming in at 3.7% outside of expectations, right? That's understandable. Very rarely does CPI come in as expected, or I guess it can, but it's definitely more varied in terms of outcomes. The federal funds decision, the Fed rate hike decision is not. The Fed rate hike decision is almost certainly what's expected, especially if it's as polarized as 99 to 1%. And so what that means is, again, I'm not saying we don't raise rates. It's possible. If we do, the market's going to tank. And I'll be very shocked if the Fed raises rates and then the market doesn't tank today. I'll be shocked if the Fed raises rates. But what that means is that the whole market, everybody already understands that it's very, 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 very probable that we're going to pause today or skip or whatever you want to call it. Depends on what they say their plan is over the. We don't know if it's a pause or skip. What they say afterwards regarding future 2023 rate decisions will determine whether today's a pause or skip. But yeah. So anyways, again, like I said earlier, everybody already expects them to pause or skip today. The real question is, what does Powell say when they interview and do the Q&A? What does he say we're going to do for the rest of the year? What does he think the rate plan is for the rest of the year? How is inflation looking on his end? What does he think? What does the Fed think, about the current economy, recession fears into next year, rate hike decisions for this year and next year, so forth, right? That's going to be the big influence over markets, over everything else. Unless we, for whatever reason, raise rates today. If we raise rates today, that's going to be a shock, a jolt to the system, but it's just not super likely. Yeah, we're gonna stream the whole thing live, like right here, like we always do. Here, I'll put this up. All right. We got the timer right there. We got about 25 minutes. 25 minutes. Peter Schiff says they're going to go up 50 basis points. Maybe. 50 isn't enough to stop inflation. They have to go back to the 70s and raise it by 1,500. Oh, it depends on time frame, Eli. With day trading, absolutely. If you're swing trading blue chip healthy companies, there is some value in my opinion, and I guess it's subjective. But if you're swing trading blue chip healthy companies or the S&P 500 or the NASDAQ, I think it's okay to bag hold a little bit. I think it's okay to be more confident in like dollar cost averaging over time. Like one of my favorite trading strategies is very simple. I look for healthy blue chip companies to pull back very large percentages short term, and companies that I think are going to be fine over the next 5 years and they're healthy. And I start to average in as they pull back. If it's a really healthy company, I'll keep adding to it as it pulls back. And then sometimes I'm just going to have to sit on it. Even if I have to sit on it for a year or two waiting for it to come back, that's okay. But a large majority of the time it comes back within a couple weeks generally, maybe a month or two. You know, Honeywell, I was losing in Honeywell for like a month and it recently ripped up and I've been making a bunch of money every day. I've only got 24 shares left of Honeywell. And again, just to show you the size of this position, I only got 24 shares of Honeywell left. And just on those 24 shares, I'm up about $160, $30 alone on this one today, and just less than 25 shares. So yeah, that's one of my favorite systems and strategies, because again, you got to understand though, you might have to sit on this. It depends on if you're okay with locking your money up. And I'm perfectly fine with that. It enables me to have a really high accuracy rate, and but I have to just be willing to sit if I need to. Yeah, I don't know what we're gonna get, man. I really don't. Yeah, SPY back down again. The market's choppy, guys. This dip is not a super shock. Remember, I told you guys that probably based off of the price action we've had today, I told you guys literally right here that I thought that I thought shorting there would be a good idea, with the thesis of if you can identify a choppy broad market ETF or fund on the FOMC days and attack the range where you short at the top and then wait for it to dip and then buy it at the bottom. That has worked. Like, that seems to be a good idea. Again, I haven't tested it yet. This is something where it's still a very early thesis. I'll have to really test it. And again, by this logic, I could start to average in right here. But you got to have a stop loss somewhere. But big dips in markets, big drops, all the way back to the bottom of the range here. Yeah, I don't know what the market's going to do. I don't know if it's going to go up, down, or sideways. I have genuinely no idea what the market's going to do, team. No idea. I don't have a crystal ball. Not an investment professional, not liable. If you lose, don't sue me. I have no idea what I'm talking about. I might be wildly wrong about anything and everything I say. Yeah, Tesla going up on the deal with Australia, the Commonwealth Bank of Australia. Tesla had a deal with them, and that's driving them up for sure. All right, guys, we got 20 minutes. 20 minutes. We got about 800 people here. Again, subscribe if you haven't. We appreciate the love. We'll see if we keep the growth up. Y'all ready? All right, so again, we'll see if the market bounces. SPY is broken all the way down. Again, we can look at the NASDAQ and see the NASDAQ was already pretty weak ahead of this, but it's been choppy too. We can look at the Dow as well. The Dow is at a really good day. I'm not sure why. But even the Dow, on its good big green day, is starting to pull back. But look at the day on the Dow, man. Dow opened the day way down here, and it has had a huge uptrend all day today. So the Dow moving resiliently relative to the rest of the world and market. Is there any way to day trade with under 25K without worrying about good faith violations? Futures. You could day trade the S&P 500, the NASDAQ, currencies, gold, silver, no PDT rule. You can use a margin account, no PDT rule. You can use funded account programs. If you want to try out futures, try a funded account program out first. Again, I'm sponsored by Top Step, and so I'm incredibly biased in their favor because they pay me money, but genuinely useful. It allows you to limit your risk. If you lose, you're out $50. Top Step Combine's like $49. If you lose, very cheap. If you're good enough to pass it, then you're going to get 90% split anyway. If you're good enough to pass it, you get to keep your first 10K in profit. Again, you can day trade with no PDT rule. Great way to learn, best of both worlds, and genuinely build your skill. And so if you want to check it out, here's the link. Cash account, you're going to be pretty restricted because listen, I've done all of this stuff. I've traded with the cash account. My TOS account's got about 200,000 in buying power, and I also trade futures, right? And so they all have pros and cons, to be honest, but the futures market is where you're going to get the most bang for your buck in terms of day trading. Better liquidity, no PDT rule, less red tape. You can still day trade the S&P, the NASDAQ, which move a lot like large caps anyway. And so, you know, but again, I'm biased because I'm sponsored by a futures funded program, but really nice. Top Steps have been around for over 10 years. They're the most legit one in the world, in my opinion. Buy or sell gold. Gold's been having a pretty good day. Gold. Yeah, gold's up today. So we can look at gold here. Here's gold. Gold's been having a pretty good day. It's up to 1970s or so. Right around 1970. Hey, thank you, Jay. I don't have to wait with a cash account. Yeah, but you can't short. You have to sometimes wait for your funds to settle. You're severely restricted in terms of buying power and equity, and you can't short. You can only go one direction. And day trading, that's a killer of profits. Being able to only go one way. It's not necessarily good for trading, in my opinion. You got to be able to take both sides, or you're going to be incredibly biased towards the long side with a cash account, because you're only going to be able to go long. If I can only go long, all I'm going to see is long patterns, right? I'm not even going to consider short patterns, and that's kind of like keeping one eye closed, you know. But again, I'm biased. The meeting is at 2:30. The actual meeting is at 2:30. The announcement's going to be in about 15 minutes or so. 15 minutes. And again, we're going to cover the whole thing live right here, like we always do. Again, if you look at the FOMC website, all right, so if you look at the website, here's all the previous Fed meetings. Again, I'll post this link up in chat if you guys want to check it out. But here's all the previous ones. All right. With that, you can see the March meeting here. May meeting, June meeting. The last one was July, which again, we raised rates 25 basis points. And the way you interpret this is, in support of these goals, the committee decided to raise the federal funds rate to 5.25% to 5.5% for their target, right? So they're raising the rate 25 basis points, right? So now we're at 5.25 to 5.50. If today's we pause or skip, it should say it'll say something like we hold the target range for the federal funds rate to the same 5.25% to 5.5%. If they're going to raise rates by 25 basis points, it'll be from 5.5 to 5.75 or 5.75. So it'll be from 5.5 to 5.75 if they raise 25 basis points, which is pretty unlikely. But this line right here is where you're going to interpret what their decision is. But again, we're going to cover it much faster anyway, so it doesn't matter. Like, we're going to cover it very quickly. And so you'll be able to stick around, listen to all of it very quickly. We get thousands of people here because we cover it fast. And so people don't have to analyze it, interpret it. We're going to interpret it for you and watch the market reaction as well. We got gold on the left. We have the SPY on the right. How much you have to put in to trade futures? I mean, it depends on where you're trading. If you have over than 25K, I mean, it's up to you, Eli. You know, it really is. Seth Rogen laugh? Is that what it's kind of like Pee Wee Herman's laugh? Like Seth Rogen and Pee Wee Herman. Rest in peace to the man Pee Wee. But they have kind of the same laugh. Maybe they don't. Pee Wee was like a giggle, like hey. Seth Rogen, I can't remember what his laugh is like. I think it was like a louder giggle, but maybe not. The decision is at 2 p.m. in about 15 minutes, 13 minutes to be exact. Can you explain bonds as if I'm a 13-year-old? Yeah, sure, man. So bonds are, most of the time when we're talking about bonds, there's three different types of bonds. There's bills, notes, and then there's bonds, right? I think a bill is less than a year. You can do bonds with anybody, but most of the time they're treasury bonds, so they're with the U.S. government. So you're basically loaning the U.S. government money for a specified period of time, and at the maturity date, which is when you get your money back, it's basically how long you're loaning them the money until the maturity date. When the maturity date hits, you get the money back. And depending on how long the bond is, like if the bond's over a year, I think they pay you annualized interest at a certain yield, right? It's really nuanced, but they pay you an annualized interest at a certain yield, and so forth and so on, right? I think it's bills are less than a year, notes are between 1 and 10 years, and bonds are 10 plus years. I think is the time frame of them. I might have gotten them mixed up though, but yeah, they're basically loaning the U.S. government but they're guaranteed returns, you know. So like the S&P 500, it'll on average give you 6 to 12% annually, but it's not guaranteed. Now, when you compare that to the lower yield bonds, which you're going to make less interest, you know, you're going to make less, you're going to have a smaller return on bonds relative to the S&P 500 or the NASDAQ or gold or whatever it is, but it's guaranteed. And so like, no matter what, you're going to get paid. Those are bonds. Yeah, we trade crypto. Yeah, I mean, there's other, like I said, there's other type of bonds, but mostly when people are talking about bonds, they're talking about treasury bonds, which is with the government. Yeah, Barry Bonds, the GOAT. All right, guys. Hey, we got 10 minutes. 10 minutes. We got about 1,500 people here. 10 minutes to go. Again, what is the Fed going to do? How much is the Fed going to raise rates today? Are they going to raise rates 25 basis points? Are they going to pause or skip? It's overwhelmingly probable that we're going to pause or skip today. If the Fed raises rates, is it an automatic short? No. I would wait just to see what the reaction is and then ride that trend maybe. For me personally, I'm not telling you what to do. I might be wildly wrong. Listen, they might come out and be like, hey, we raise rates 50 basis points and the market rips up 5%. I have no idea. I think that's incredibly unlikely. I think it's more likely that they're going to say, today it's most likely that they're going to say, hey, we pause or skip. If for whatever reason they go outside of that expectation where they raise rates any amount, I think personally the market's going to tank because that's going to be a shock because it's just so unlikely. And that shows that the Fed, the reason the markets are probably going to go down if that happens is because it shows that the Fed is skeptical in terms of a soft landing and some other nuances behind that. So that's basically to shorten it. It shows that the Fed is skeptical and worried if they are going to raise rates regarding inflation. Now, a lot of people think we should raise rates today, and I kind of agree with them because that's going to do more damage to inflation long term. But it is going to cause more short-term pain if we, most likely at least, if we raise rates today versus the expected pause. Yeah, I mean, if the Fed doesn't raise rates, will market pump? Probably not. I mean, anything could happen. It's possible. To understand this, though, it's all relative to expectations, right? So again, like everybody expects that we're going to skip or pause today. So I would look at that as a neutral reading. And if that happens, which is overwhelmingly expected, again, I keep saying it because it's true. If that happens, think of that as a neutral reading, an as expected reading, and then move over to what Powell says during the conference to guide you on sentiment. That's what I would personally do. Again, I might be wrong. I have no idea what I'm talking about. I might be widely wrong about everything. Don't sue me. But that's what I would personally do. If we skip or pause, which is pretty likely, I would then pivot to look at what Powell says during the conference. That would be what's guiding my specific sentiment. But again, I've covered enough of these to see, while the outcome of the Fed meeting might be predictable in terms of rate hike decision, even sentiment from Powell, predicting what the market is going to do based off of those two things is much less accurate. And so just be careful. And look, again, the SPY did exactly like I said it would. Remember, I told you my theory was that you can be able to short up here and then cover at the bottom on these choppy days. And we got exactly that. We bounced right at the bottom. I might have to test that theory. Looks profitable. Maybe not, though. All right, guys, we got 7 minutes, 7 minutes. Even if they raise it, the market has absorbed it. I don't think so. I think the market has absorbed them skipping today, not them raising rates. I think if they raise rates, it's going to be, the market is not prepared for that. And I think that's what's going to cause a brash reaction. Right, for sure. You see that TV, man. My idea worked. I'm gonna have to test it. Again, you got to be patient and just wait for these type of days. But, you know, maybe there's a thing where like you go heavy on these days. All right, I'm gonna go ahead and pause this and fix the timer. I think my timer's a little bit off. All right. All right, there we go. All right, guys, get ready. We got 5 minutes. They will pause today. Yeah, I'm pretty certain they're going to pause too. Oil has been ripping up the last couple of days. I've been in Exxon. I bought Exxon a couple weeks ago, I think, and Exxon's been doing really well. I had 10 shares. I made, pretty good money on 10 shares. So KNT, it's not in 10 minutes. Powell's going to speak in about 35 minutes to be exact. And so it's not in 10, it's in about 35, 40 minutes. Yeah, it's unlikely they're going to raise, guys. Again, I see a lot of people voting on that. 40% of you guys are voting that they're going to raise. It's just so unlikely. Again, maybe I'll eat my words. It's possible. I just don't think I am. Hey, John, can you repeat your strategy for today? I just said what I said earlier, and I have to be quick because we're getting pretty close to the decision. Yeah, so what I said here, let me. So what I said was, like, once you get on these choppy days, like ahead of FOMC meetings, ahead of rate hike decisions, ahead of maybe CPI, ahead of big earnings results, when everybody's kind of neutral and apprehensive and liquidity is low, attack the chop. So like basically look for confirmation. And so like something like this where you go up, down, down. Once you have that confirmation right there, you wait for it to get back to the bottom of the range and you buy it. You wait for it to get back to the top of the range and you short it. Wait till it gets back to the bottom of the range, you buy it. Leading up to the Fed meeting. Once the actual outcome is there, then you stop because that could increase volatility. But just attack the chop. That was an idea I had earlier. Again, just kind of spitballing, throwing stuff out here. I don't know if it would actually work. But again, what I said was that shorting here might be a good idea if that strategy works. And this was way back here. And then after I said that, we did this. And then I said, when we dipped down here, I said, okay, to follow that same strategy, you would be buying right here. And then afterwards it did this, right? And so again, makes sense. Everything's not going to be choppy. And so you do need that confirmation. Like, so you do need that identification to choppiness like this. But, you know, just throwing stuff out there. It works. I do that. Yeah, maybe. Yeah, for sure, Tessie. Like a sideways trend or channel for sure. All right. So if the FOMC raises rates, then that means the SPY market goes up? No. No. Opposite, Sammy. If the Fed chooses to raise rates, it's going to be really unexpected. And so that most likely means the market's going to drop because more rate hikes mean more short-term pain, although more long-term damage to inflation. Again, it's just theory. This is all theorized here. We don't really know nobody knows what's going to happen in 3 minutes. Nobody knows. So we're just theorizing here. I have no idea what we're going to get. That's my guess. If we do shock the system and raise rates today, which again is unlikely, the market's probably going to fall because the market's baked into a pause or skip right now. So again, it's just going to be unexpected if we do. I'm going to pull up the Fed website. I'm also going to put it up in chat so you guys can see it if you guys want to see it. This is the website. Again, the rate hike decision is going to pop up right here. You can see September, which is now September 20th. It's going to pop up right here. HTML should be right there, just like this, right? But we're gonna interpret it, so you won't need to do this. But yeah, I'll put the link up here if you want to check it out. I'm also going to throw it in sub only mode. So I'm also going to throw this in sub only mode. So everybody subscribe if you haven't yet. Announce yourself. So let's say you're subscribed. We appreciate the love. Help us break 115K. Here's the website link right now if you want it. We got over 3,000 people here. We still got 2 minutes. Yeah, we're going to watch the entire speech. We're going to stream the whole thing live like we always do. So if you're subscribed, announce it. We appreciate the love. Thank you. How do you decide that a pause was priced into the market? Because everybody already expects it. This means priced in right here. Yeah, this means 99% of people expecting a pause means that a pause is priced in. All right, guys. 1 minute. 1 minute. Make sure you all hit the live button next to the play button. You want to make sure you're fully caught up on stream so you can catch this. Again, hit the live button. If your live button looks gray like this, it's wrong. It needs to be red. You want it to be red. And so click this live button right here. You should be able to click it, and it'll catch you back up to the stream. 40 seconds. 40 seconds. Does it ever go against what they think? It can. It's unlikely. It does, but it's not very common. All right, guys, let's get ready. Again, I'm going to interpret this for you guys, so you won't have to do anything. Again, we're going to interpret it pretty quick. All right, there goes my timer, but we still got 20 seconds, guys. We still got 20 seconds. And so the rate hike decision is going to come out, and then at 2:30, they're going to 10 seconds, guys. 10 seconds. Here we go. 5, 4, 3, 2, 1. There we go. All right, market's down. All right, so we're waiting here. We're waiting. Market's consolidating. They haven't actually posted it yet. It's most likely, it looks like this was a pause or skip, although we haven't actually seen it yet. There we go. All right, so. Okay, so yeah, it's a pause. It's a pause. They maintained the target range for the federal funds rate to 5.25% to 5.5%. They paused as we said we would. Again, we told you all they would pause, and that's exactly what we got. And so again, going by my previous thesis, guys, going by my previous thing, since they did what was expected, which we told you all they would, next thing is we're going to wait for Powell to speak in 30 minutes. Powell speaks in 30 minutes. That's going to influence everything else. So again, they paused or skipped. They maintained the federal funds rate at 25 basis points. They paused or skipped. Market's not liking this. Market's dipping down to 442s. Technically, this is a neutral reading. All right, so technically this is neutral. Okay, but what's going to matter more than any of this, as we said earlier, is what the Fed says during the interview. And again, we paused or skipped. So yeah. So again, we pause or skip. Put this up on screen, and now at 2:30, guys, at 2:30, that's going to be the influence over the market at 2:30. What Powell says during this meeting is huge. They did what was expected. The market has dipped down a little bit. It's really not a small reaction. This is a pretty big dip from a pause or a skip, which is already expected. 99% of people expected a pause or a skip. So we dipped down a little bit. Again, this doesn't mean much. What Powell says during the press conference is going to mean more than any of this. So, hey, we'll see what happens. Again, if you haven't already subscribed, we got about 5,000 people here right now, about 5,000 people. So I appreciate the love and support. Thank you for choosing beginner trading. Again, we cover all this data very quickly, guys. We cover all this data very quickly. We don't sell a course. We don't claim to be an expert. We don't act like a guru. We get thousands of people here because we report this quickly and reliably. We cover all the major economic reports, earnings, CPI, PPI, Jerome Powell press conferences. We cover all that stuff, and we stream it all live here for free. And so subscribe if you haven't yet. I appreciate the love and support. Again, we'll see what Powell says. We're going to end this poll now that we have the outcome out here already. We're going to end this poll. Again, 40% of you were wrong, as we told you y'all would probably be. And so now we're going to do another poll. Does Powell have a dovish or hawkish tone during today's FOMC meeting? I like a dove. I'm like a hawk. I have no idea what I'm talking about. All right, there we go. Vote on the poll, guys. Definitely top 3 greatest polls ever right now. Check it out. Again, if you haven't already, check out Top Step. Top Step is a way to day trade these economic releases. You can day trade in futures, and there's no PDT rule. You can day trade the S&P in what's called the E-mini. You can day trade the NASDAQ. You can basically day trade the SPY or the Q in futures, no PDT restrictions. Top Step is a great way to learn. They get some haters, but most day traders lose money. It doesn't matter if you're on Top Step or not. Most day traders lose. And the base combine on Top Step's $49. They're going to give you a demo and test your skill. If you're good enough to pass it, you know, basically you got to make on that 50K demo, you got to make 3K without losing over 2K. If you can pass that test, they fund you 50K with a 90% split, and they pay out millions and fund thousands of traders a year. They've been around for over a decade. If you lose, you're going to lose much less than you would putting up the money yourself. And so it's the best of both worlds. It's a great way to learn, and just taking that challenge builds your skill. Although I'm definitely biased in their favor because they pay me money. They're a sponsor of mine. I always try to be transparent and honest. But if you want to check them out, here's the link. And again, we'll see what they say during this actual meeting. You can also find the link in the description as well. Looking at some votes on the poll, we got about 800 votes already. 29% say fly like a hawk or fly like a dove. 43% say dive like a hawk. And 28% say I have no idea. It's called Top Step. Check out the link in the description. The market's a beauty contest. Yeah, you can. They recently changed that rule, a deal, where you used to not be able to trade during the economic reports, but now you can. There's no restrictions on when you trade anymore on Top Step. I'm pretty sure. I might be wrong, but I'll have to go check out that site. Well, FTMO is Forex, and Forex is just hard to find liquidity. But again, they're a sponsor of mine. I'm biased, of course. I always tell you guys that. They pay me money. That's naturally going to make me biased in their favor. Never try to hide that. I don't even claim to be an expert or a guru. You know, we're going to have sponsors. That's pretty understandable. I'm not sitting here for 4 hours a day out of the kindness of my heart. Nobody is. And I'd rather trust somebody that's just real about it than somebody saying, hey, guys, you know, I'm just out here trying to help people. You know, get out of here, bro. No, you're not. You know, I'd rather people be honest, and I'd rather be honest about it. Can you explain why the U.S. dollar is strong after that decision? Well, I mean, there's a lot of nuance behind what the Dixie and the market is doing, right? So the Dixie's going to move up. The market's moving down, right? So generally, these two are going to have an inverse correlation with each other. There's a lot of reasons for that. The main one, or there's a bunch of different ones, right? But one of them is that if your cash is gaining value and you're a whale, you know, if you got a lot of money and your cash is gaining value, are you going to take that money and put it into other things, or are you going to sit on your cash as it gains value? You're going to sit on your cash. If you're holding cash and your cash is losing value, what are you going to do? You're going to sit on your losing value cash? No, you're going to take it and you're going to put it in the S&P 500. You're going to put it in real estate. You're going to put it in whatever. You're going to put it in a broad market S&P 500 ETF or whatever you want to do, right? And so because of that, there's an inverse correlation a lot of the time, as well as the fact that the market moving down and the Dixie moving up. Dixie moving up signals inflation. A pause is being interpreted by the market right now. The real reason the Dixie's moving up is because a pause is being interpreted as worse for inflation problems, right? And inflation problems means good for the dollar, if that makes sense. So that's basically the nuance of it, but it's tricky and nobody really knows one way or the other. Again, I'll tell you guys this, right? A lot of times, like especially day traders, they tend to sensationalize market reactions. This isn't a huge drop relative to what we might get during the actual press conference. So like this dip is not the biggest dip in the world, right? A lot of the time you'll see massive dips from earnings, from CPI, from FOMC decisions. This is not the biggest dip, right? Is this a small dip? No, but like it's not out there to see dips that are like this from these things. Okay. And so this dip is actually a pretty neutral reaction considering we came in as expected regarding like what the Fed chose to do. And so this is basically nothing right now. Is it bullish? Of course not. It's bearish, definitely. But this is not the biggest reaction. It's actually pretty small. And the market is, again, you can see this light blue line right here is the previous closing price. That's the red to green level of the SPY, right? So with this in mind, the SPY is basically flat on the day. It's slightly red, very, very slightly red. But that can very much change when the Fed talks in about 20 minutes. Oh, yeah, let me put a timer up for the actual press conference here, guys. Hold on. This is going to be in about 21 and a half minutes or so. There you go. Yeah, so the Powell speech is in 2:30. Here, I'll put this up on screen. Powell speaks at 2:30. All right, there you go. Powell usually speaks, I would say it's about like 30 to 40 minutes, sometimes less, sometimes more. Depends on how long the Q&A drags on usually. Again, what he says is going to be a big influence. You know, again, what you want to pay attention to in terms of like buzzwords or stuff like this. What you want to pay attention to in terms of buzzwords is inflation expectations, like what the Fed is choosing to do during this, like what the Fed expects here for the FOMC decision, like what they're going to choose to do for the rest of this year, right? So for 2023, are we going to raise rates again? Are we going to pause for the remainder of the year? What are the recession expectations like? Are we going to hit a recession in early 2024? Are we going to stay safe? Or is it going to be a soft landing? Are we going to continue to raise rates next year? Like what the plan is moving forward, that's going to influence the market heavily. You know, what we're pretty safe to say, like Powell's going to say inflation is still elevated and they're attentive to their 2% goal over time. He always says that. But changes to those plans, again, previously he said they were going to raise rates 2 more times this year, which would be 50% of the rate hikes, which would make sense since they paused today. That next cycle, they're going to do 25 basis point rate hikes. We can look at the CME watch tool and see what they're looking like for November now. All right, so again, here's the November expectations. And again, so far, you can see 0.7% of people think we're actually going to cut rates. Or no. I'm sorry. Wait, where are we at? Okay, yeah, we're at 5.25 to 5.5. So we're right here, right? So 70.5% of people think in November we're going to pause or skip again, or we're going to stay paused. I should say now. 0.7% of people think we're going to cut rates back down to 500 to 525, and then 28.5% of people think we're going to raise 25 basis points. So that is the probabilities. Again, you can look at on the site and select November right here to see what the plan is there. The Dixie's still moving up. We're at 105s, 105.13s. Who's streaming schedule? Mine? I stream every day. Economic reports, we stream more. Depends on what's going on. Sometimes we just don't have much going on. We're just kind of hanging out. Anyone guess Hawk or Dove? I don't know. We can see the polls. So again, the polls, we got 39% of people saying we're going to dive like a hawk. 31% say we're going to fly like a dove. Honestly, my dad is a falconer, believe it or not, right? So, like, I know about hawks. Like, my dad's a falconer. Let me find this picture. Hold on. But speaking of hawks, I should be a natural, like, bear. Just because of... Look, here's young John. That's me when I was, like 10? And look, there's my dad. That's a that's a Harris hawk, actually. So that's a Harris hawk. Red-tailed hawks are actually much bigger than this. It's a Harris hawk, so it's like a little bit smaller. But yeah, my dad's actually a falconer in Louisiana. So I should be a huge bear in the market, but I'm more bullish, I would say. I'm more of a dove, but that's okay. Yeah, they're real. Tony Hawkish. If he's, I don't know. He's probably Powell's usually a pretty good speaker. Illuminati. My dad's probably the dude so far outside of the Illuminati. I don't even think they would take him. Yeah, I'm from Baton Rouge. Did your dad teach you about stocks? No. I'm not saying, I don't even know if my dad ever invests or trades. My dad wasn't like super rich, if that's what y'all are insinuating. I was pretty middle class, man. I didn't, If you're from Louisiana, your family usually hunts something. My dad just was, a little bit different and hunted with birds instead. All right, guys. So, again, the dollar index back under the previous closing price. The market's pretty flat, and it's been choppy really for the last 15 minutes. We still got 15 minutes into the actual announcement and decision, but yeah. Yeah, go Tigers. How about that? How about LSU, man? I don't even want to be reminded about Florida State. But we beat Mississippi State, and that's all I really care about right now. The Saints are doing good too. Carr, he's living life. He's doing his thing. The games had me stressed watching them, but the Saints are 2-0. LSU's 2-3. Life is good. The Bengals and Joe Burrow, Joey B, my guy, they might be 0-2, but nobody tell me that. We'll see what the Astros do this year too. All right, guys. Hey, market's flat. We'll see what Powell says. Also, another one of my sponsors. Again, this is only the second plug I've done all stream, and I've been streaming for like an hour and a half now. So don't get too mad. Another one of my sponsors is a company called Chart Prime. Really useful. I've got like a bunch of alerts set up. And again, I'm going to preface this with like, look, I can't guarantee you're going to make money. Nobody can. Okay. These are just custom trading view indicators and alerts, and it's like $40 a month. It's pretty cheap. But where this is useful is because you can put up all these different types, right? So I can put up, personally, my favorite is the regular market oracle, right? The regular market oracle is my personal favorite. Or no, the market oracle pro, I mean, is my personal favorite. And you can kind of see why. All right, so here's a little experiment. Look at when it says strong, and look at how accurate that signal is when it says strong. Okay. And again, I can't guarantee you're gonna make money. Nobody can. But like, look at this. Strong signal here. Bounce. And this is a 5-minute chart. So this is like 3 hours of green. Strong signal here. You get like what, 20 minutes of green. Buy signal here. Nice bounce. Sell signal here. Drop. Sell signal here. Drop. Buy signal here. Bounce. This one was wrong. But this one was right too. Sell signal here, drop. And this is the E-mini and futures that I'm trading on Top Step. And so I use these to pass the combines as well. Look at this one, sell signal here. Look at that big red action here. And so I can't fake that. And this is just a small piece of what they offer. Like, look, I could put up chart patterns. I could put up oscillators, smart money concepts. I could put up the regular market oracle, which shows me more reversals. Like, look, I can see the rising wedge. And look at the break of that wedge and then the hold of the resistance line. I can take off the market oracle pro, and you can see reversals. So again, look at the short-term price action here. Reversal down, drop. Reversal up, bounce. Reversal down, drop. This one was wrong. But again, everything's not going to be correct. But when you add it all together and it's $40 a month and you can use it in stocks, crypto, Forex, futures, it's genuinely useful in my opinion. But again, I'm definitely biased because they pay me money and I'm a sponsor. And that'll be my last plug for a little while. But if you want to check it out, link is in the description. Again, I'll put this up as well. Great way to help support the channel. And it's pretty cheap. And yeah, if you want to check it out, here's the link. So again, we'll see what Powell says during the conference. Crude is going to fly, man. Oil's been on a run the last week or two. I've been in Exxon, a small position, but I've made some money with it. So flawless plug. Listen, we're definitely the top 3 pluggers in the world right now for sure. Definitely top 3. Get your mind out the gutter. Again, we'll see if we get some good action in the market today. Market's pretty flat. You can see choppiness. We got 12 minutes. Years ago, the Fed was signaling repeatedly that they wanted to move inflation up to 2% average. But yeah, they're still signaling that. They've been saying that for freaking years now. I'm not sure when they're going to hit it. I doubt they'll hit it this year or next. They'll probably hit that in 25 maybe, is what my guess is. But when do y'all think they'll hit 2%? It's not going to be anytime soon. It's called Chart Prime. You can see the link in the description. You can see the links for all my sponsors in the description. I also posted it in chat if you scroll up. What do you think about Euro US dollar? I don't really trade Forex. I like futures a little bit more because again, in futures, I can day trade, I can short, I can do all that cool stuff. And there's no PDT rule. Forex, you got to use like VPNs and all this crazy stuff. So Forex is just much harder to, yeah, Forex is just much harder to like get done. That makes sense, but you know what I'm pretty pumped about? We got more people in this stream than Yahoo Finance. That's really nice, man. Hey, shout out to you guys. Y'all know who the real channel is over here. Look at this. Here's Yahoo Finance. They got 2.9 thousand people here. We are flexing on them with our 3,300 people. Thanks so much, guys. Hit the like button. I appreciate it. I'm semi-joking. But yeah. All right. What was I doing? Okay, that's what I was doing. Let me fix this. All right, so we got the press conference coming up. There we go. Dollar index is pretty flat. SPY is pretty choppy. I wonder if you could short right here and just ride it back down to the bottom of the range. Only like a very quick 10-minute trade. I'm not telling you to do it. I have no idea what you should do. But that kind of makes sense. Powell's definitely a hawk. Yeah, definitely top 3 streams. Kick your dog. Does anybody ever remember Tom Green? I think was his name. You come to my house. Those are the old days, man. I'm old. I realize how old I am now. A lot of y'all probably don't even remember what I'm saying. Hawkish? The market's definitely reacted bearishly short term. Now, anything could happen. after the press conference. Again, everybody's waiting to see what Powell says. Like that's what's happening here. Is the market is slightly bearish. Again, my guess is we're bearish because a pause signals less damage done to inflation over time. It's one of the reasons the dollar index is pushing up, and the market has dropped a little bit. And again, judging by the past economic reports, like we've had many economic reports where the economic reports have signaled economic growth, like higher payroll numbers or less jobless claims numbers, and the market has dropped, which signals inflation fearing market. Now, if the market reacts positively to economic growth, then that signals a more recession fearing market, a more conventionally moving market, if that makes sense, right? Yeah, Tom Green. Yeah, he was super weird. Hey, thank you, gamer. Yeah, CJ knows. Yeah, CJ knows. Yeah, he was a comedian. He did he was in a bunch of movies. One I can't really say the movie he was in, the one that comes to my head because it's not really appropriate, but and my wife goes around telling everybody about my YouTube channel, you know? Like I don't want my kids' teachers to know about my freaking YouTube channel. Then I gotta like sit here and, you know, worry about that. I just want to be able to joke around. Anyways. If you're doing Forex, what kind of VPN would you recommend? I don't know. NordVPN. Encino, man. We watched that not too long ago. I showed my daughter and my son like all the 90s movies. My kids have been in like a jujitsu kick lately because we've been doing jujitsu, and so I showed them Never Back Down. So cheesy and ridiculous, but just great movie. You know, you gotta love it. We watched Big Daddy the other day, Happy Gilmore, Encino Man, Lord of the Rings, you know. Yeah, don't worry about LSU this weekend. They'll definitely beat my Razorbacks. Yeah, I mean, we should. You never know. I mean, football's football. Yeah, Pawn, you know, too. Yeah, I mean, I can, like, listen, you can trade Forex, and that's okay, and I understand wanting to trade Forex, but, like, it just seems so much work where you can get the same thing done in futures. Like in futures, you can day trade the S&P, the NASDAQ, some currencies, gold, like all these different equities, the Dow. So like, what do you need to trade Forex for? It's easier to find consolidated volume if you're trading the S&P 500 or the NASDAQ anyway, versus pairs and Forex. It's much more difficult to trade, but maybe it's just because I'm ignorant of Forex. Certain that's definitely possible. Maybe I'm just biased against it, but. All right, hey, we got 6 minutes. Yeah, you can trade some currencies on Top Step. Yeah, I don't know what you're saying, Holy, but I'm going to assume you're trying to make me say something I shouldn't, and so I'm just not going to say any of that. Yeah, Brian Kelly's all right, but like, I think Daniels is overhyped too. I think Daniels is good unless he gets that pressure put on him, and then he chokes. And I like Daniels. I think he's got some skill, great running, great scrambles, you know. But I don't know, man. That Florida State game, maybe Florida State's just good, but the margin in which they beat us was the most disappointing. If it was a close game, fine, but like they beat us like 50-20 something, right? So that's what I was mostly, you know. I'm not mad. I'm just disappointed at Daniels. Okay. The E-mini started to bounce up a little bit here, back over the previous closing price. So the SPY is technically green on the day right now, guys. So the SPY is technically green. We'll see if it holds. Again, very neutral, very flat day in anticipation of the actual press conference here from Powell. All right, so we're gonna get this ready, team. Oh, I gotta switch my headphones out, man. I almost forgot. Y'all were just gonna let me go through with this without switching my headphones out. All right, guys, hold on. I'm getting the screen up right now. I'm fixing the screen up right now. All right, guys, we got like 3 minutes. Again, here's the press conference. We're just kind of waiting. All right, we're gonna put. What do y'all want? The Dow up? What do y'all want? The E-mini up? The SPY? The Nasdaq? I'm gonna put the Nasdaq up. I like the Nasdaq a little bit better, which is the Q basically. What the heck is this? There you go. All right. All right, so here's the Nasdaq again, starting to pop up a little bit, trying to go green on the day. All right, here, let me switch my headphones out before. All right, let me fix this. All right, let me do a sound check. Can y'all hear me right now? I'm going in here. I'm gonna get the fire in the background. Can y'all hear the music right now? Can you? Let me know. I'm just gonna do this right here. All right, cool. All right. Yeah, I'm gonna turn the music off right now, and I'm also going to make sure this is loud. I'm gonna mute the background music to make sure they don't play any. Okay, there we go. I know y'all can't hear it right now. We're just waiting for it to start. Again, you can see it hasn't started yet. Again, will they raise rates today? I don't know. This is bullish. All right. How do you personally think the market is going to react? I don't know. Honestly, it's so hard to tell because we don't know what their plan is. Like, we don't know. All right, this starts in 20 seconds. We don't know what Powell's going to do. Listen to what their inflation expectations, what their rate hike expectations are. All right, here we go. All right, so we're waiting for Powell to come out. He hasn't come out yet. Patiently waiting here. Here he comes. All right.
Good afternoon, everyone. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. We understand the hardship that high inflation. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. We've raised our policy interest rate by 5.25 percentage points and have continued to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. Today, we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Looking ahead, we're in a position to proceed carefully in determining the extent of additional policy firming that may be appropriate. Our decisions will be based on our ongoing assessments of the incoming data and the evolving outlook and risks. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a solid pace. And so far this year, growth in real GDP has come in above expectations. Recent readings on consumer spending have been particularly robust. Activity in the housing sector has picked up somewhat, though it remains well below levels of a year ago, largely reflecting higher mortgage rates. Higher interest rates also appear to be weighing on business fixed investment. In our Summary of Economic Projections, or SEP, committee participants revised up their assessments of real GDP growth, with the median for this year now at 2.1%. Participants expect growth to cool, with the median projection falling to 1.5% next year. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 150,000 jobs per month, a strong pace that is nevertheless well below that seen earlier in the year. The unemployment rate ticked up in August, but remains low at 3.8%. The labor force participation rate has moved up since late last year, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. FOMC participants expect the rebalancing in the labor market to continue, easing upward pressures on inflation. The median unemployment rate projection in the SEP rises from 3.8% at the end of this year to 4.1% over the next 2 years. Inflation remains well above our longer run goal of 2%, 4% over the 12 months ending in August, and that excluding the volatile food and energy categories, core PCE prices rose 3.9%. Inflation has moderated somewhat since the middle of last year, and longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Nevertheless, the process of getting inflation sustainably down to 2% has a long way to go. The median projection in the SEP for total PCE inflation is 3.3% this year, falls to 2.5% next year, and reaches 2% in 2026. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. As I noted earlier, since early last year, we have raised our policy rate by 5.25 percentage points. We see the current stance of monetary policy as restrictive, putting downward pressure on economic activity, hiring, and inflation. In addition,
yeah, their YouTube channel has been glitchy today, man. You'll see,
the economy is facing headwinds from tighter credit conditions for households and businesses. Range for the federal funds rate at 5.25 to 5.5%, and to continue the process of significantly reducing our securities holdings. We are committed to achieving and sustaining a stance of monetary policy that is sufficiently restrictive to bring inflation down to our 2% goal over time. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely.
So 2% in
most likely
2027.
scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.6% at the end of this year, 5.1% at the end of 2024, and 3.9% at the end of 2025. Compared with our June summary of economic projections, the median projection is unrevised for the end of this year, but has moved up by a 0.5 percentage point at the end of the next 2 years. These projections, of course, are not a committee's decision or plan. If the economy does not evolve as projected, the path of policy will adjust as appropriate to foster our maximum employment and price stability goals. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. Given how far we have come, we are in a position to proceed carefully as we assess the incoming data and the evolving outlook and risks. Real interest rates now are well above mainstream estimates of the neutral policy rate, but we are mindful of the inherent uncertainties in precisely gauging the stance of policy. We're prepared to raise rates further if appropriate, and we intend to hold policy at a restrictive level until we're confident that inflation is moving down sustainably toward our objective. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We remain committed to bringing inflation back down to our 2% goal and to keep.
Yeah, this is on their end, man. Their latency has not been good today.
Keeping longer-term inflation expectations well anchored is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
All right, so we'll see what they're doing. So cycle by cycle is what I heard is what they're going to plan to do.
Colby Smith with the Financial Times. What makes the committee inclined to think that the Fed funds rate at this level is not yet sufficiently restrictive, especially when officials are forecasting a slightly more benign inflation outlook for this year? There's noted uncertainty about policy lags. Headwinds have emerged from the looming government shutdown, the end of federal childcare funding, resumption of student debt payments, things of that nature.
Right. So I guess I would characterize the situation a little bit differently. So we decided to maintain the target range for the federal funds rate where it is at 5.25% to 5.5%, while continuing to reduce our securities holdings. And we say we're committed to achieving and sustaining a stance of monetary policy that's sufficiently restrictive to bring down inflation to 2% over time. We said that. But the fact that we decided to maintain the policy rate at this meeting doesn't mean that we've decided that we have or have not at this time reached that stance of monetary policy that we're seeking. If you looked at the SEP, as you obviously will have done, you will see that a majority of participants believe that it is more likely than not that it will be appropriate for us to raise rates one more time in the 2 remaining meetings this year. Others believe that we have already reached that. So it's something where we're not making a decision by deciding to about that question by deciding to just maintain the rate and await further data.
So right now, it's still an open question about sufficiently restrictive. You're not saying today that we've reached this level.
We're not saying, no. Clearly, what we decided to do is maintain the policy rate and await further data. We want to see convincing evidence, really, that we have reached the appropriate level, and we're seeing progress, and we welcome that. But we need to see more progress before we'll be willing to reach that conclusion.
And
so
just
no
on
guidance.
the 2024 projections, what's behind that shallower path for interest rate cuts and the need for real rates to be 50 basis points higher?
Right. So I would say it this way. First of all, real interest rates are positive now. They're meaningfully positive. And that's a good thing. We need a policy to be restrictive so that we can get inflation down to target, okay? And we're going to need that to remain to be the case for some time. So I think, remember that of course, the SEP is not a plan that is negotiated or discussed really as a plan. It's accumulation really. And what you see are the medians. It's accumulation of individual forecasts from 19 people. And then what you're seeing are the medians. So I wouldn't want to, bestow upon it the idea that that's really a plan. But what it reflects, though, is that economic activity has been stronger than we expected, stronger than I think everyone expected. And so what you're seeing is this is what people believe as of now will be appropriate to achieve what we're looking to achieve, which is progress toward our inflation goal, as you see in the SEP.
Thanks. Let's go to Rachel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. How would you characterize the debate around another hike or holding steady? Is it discussion around lag times, fear of too much slowing, too little slowing? Could you walk us through what this disagreement was about at the meeting?
Yeah, so the proposal at the meeting was to maintain our current policy stance. And I think there was obviously unanimous support for that. But this, of course, is an SEP meeting, and so people write down what they think. And you have some, you saw, I think 7 wrote down no hike at this meeting, or between now and the end of the year, and I think 12 wrote down another single hike in one of the next 2 meetings that we have between the end of the year. So it wasn't like we were arguing over that. People just stating their positions. And really, what people are saying is, let's see how the data come in. We want to see. What we want to see. We want to see that these good inflation readings that we've been seeing for the last 3 months. We want to see that it's more than just 3 months, right? We want to see, the labor market report that we received, the last one that we received, was a good example of what we do want to see. It was a combination of across a broad range of indicators, continuing rebalancing of the labor market. So those are the 2 things. Those are our 2 mandate variables, and that's the progress that we want to see. But I think people, they want to be convinced, they want to be careful not to jump to a conclusion really one way or the other, but just be convinced that the data, support that conclusion. And that's why, given how far we've come and how quickly we've come, we're actually in a position to be able to proceed carefully as we assess the incoming data and the evolving outlooks and risks and make these decisions meeting by meeting.
And in your view, I know nothing has been decided yet, but what would one more hike at the end of the year do to the economy or to inflation? And on the other side, what would no hike do, if you could sort of game that out for us?
So, you can make the argument that one hike one way or the other won't matter, but for us, we're trying, obviously as a group, it's a pretty tight cluster of where we think that policy stance might be, but we're always going to be learning from data. We've learned all through the course of the last year that actually we needed to go further than we had thought. If you go back a year and what we wrote down, it's actually gotten higher and higher. So we don't really know and that's why, again, we're in a position to proceed carefully at this point. A year ago, we proceeded pretty quickly to get rates up. Now we're fairly close, we think, to where we need to get. It's just a question of reaching the right stance. I wouldn't attribute huge importance to one hike in macroeconomic terms. Nonetheless, we need to get to a place where we're confident that we have a stance that will bring inflation down to 2% over time. That's what we need to get to, and we've been moving toward it. As we've gotten closer to it, we've slowed the pace at which we've moved. I think that was appropriate. And now that we're getting closer, we have the ability to proceed carefully.
Let's go to Steve.
This all seems pretty neutral to me, to be honest.
CNBC. Mr. Chairman, I want to return to Colby's question here. What is it saying about the committee's view of the inflation dynamic in the economy that you achieve the same forecast inflation rate for next year, but need another 0.5 point of the funds rate on it? Does it tell us that the committee believes inflation to be more persistent, requires more medicine effectively? And I guess a related question is, if you're going to project a funds rate above the longer run rate for 4 years in a row, at what point do we start to think, hey, maybe the longer rate or the neutral rate is actually higher? Thank you.
So I guess I would point more to, rather than pointing to a sense of inflation having become more persistent, I wouldn't think that's not, we've seen inflation be more persistent over the course of the past year, but I wouldn't say that's something that's appeared in the recent data. It's more about stronger economic activity, I would say. So if I had to attribute one thing, again, we're picking medians here and trying to attribute one explanation, but I think broadly, stronger economic activity means rates. We have to do more with rates, and that's what that meaning is telling you. In terms of what the neutral rate can be, we know it by its works. We only know it by its works, really. We can't the model.
Yeah, again, their stuff has been kind of off, man. Again, this is on their end. You can see it's still
The
live.
economy reacts, and again, that's another reason why we're moving carefully now, because there are lags here. So that it may of course be that the neutral rate has risen. You do see people. You don't see the median moving, but you do see people raising their estimates of the neutral rate, and it's certainly plausible that the neutral rate is higher than the longer run rate. Remember, what we write down in the SEP is the longer run rate. It is certainly possible that that the neutral rate at this moment is higher than that, and that's part of the explanation for why the economy has been more resilient than expected.
Let's go to Howard.
Howard Schneider with Reuters. Thank you. So you've said several times that the economy needed a period of below trend growth to get inflation consistently back to 2%. You kind of get that in 2024, a little bit. 1.5% is just a touch below what's the estimate of potential. So the fact that you're getting so much done at so much less cost, does that represent a change in how you think inflation works, a change in how you think the economy works, a change in the mix of supply healing versus demand destruction that's necessary to achieve this?
Yes, of course, it is a good thing that we've seen now meaningful rebalancing in the labor market without an increase in unemployment, and that's because we're seeing that rebalancing in other places, in, for example, job openings, and in the jobs worker gap. You're also seeing supply side things, so that's happening. I would say, though, I still think, and I think broadly people still think, that there'll have to be some softening in the labor market that can come through more supply, as we've seen as well. Also, remember, the natural rate we think is coming down, which is a supply side thing, so that the gap between any given unemployment rate that's lower than that and the natural rate comes down. That's a way for that's a way for the labor market to achieve a better balance. So all of those things are happening. You're right. In the median forecast, we don't see a big increase in unemployment. We do see an increase, and but that really is just playing forward the trends that we've been seeing. That is not guaranteed. There may come a time when unemployment goes up more than that, but that's really what we've been seeing, is progress without higher unemployment for now.
So just to boil that down for a second, we've gone from a very narrow path to a soft landing to something different. Would you call the soft landing now a baseline expectation?
No, I would not do that. I would just say, what would I say about that? I've always thought that the soft landing was a plausible outcome, that there was a path really to a soft landing. I've thought that, and I've said that since we lifted off. It's also possible that the path has narrowed and it's widened. Apparently, ultimately, this may be decided by factors that are outside our control at the end of the day. But I do think it's possible, and I also think this is why we're in a position to move carefully again. That we will restore price stability. We know that we have to do that, and we know the public depends on us doing that, and we know that we have to do it so that we can achieve the kind of labor market that we all want to achieve, which is an extended period, sustained period of strong labor market conditions that benefit all. We know that. the fact that we've come this far lets us really proceed carefully, as I keep saying. So I think, that's the end we're trying to achieve. I wouldn't want to handicap the likelihood of it, though. It's not up to me to do that.
Nick Tamaros of the Wall Street Journal. Chair Powell, both you and Vice Chair Williams have indicated that sufficiently restrictive will be judged on a real rather than nominal basis, implying some scope for nominal rate cuts next year, provided further compelling evidence that price pressures will continue to subside. Is the FOMC focused on targeting a real level of policy restriction? And can you explain what would constitute enough evidence that will allow the FOMC to normalize the nominal stance of policy while keeping real policy settings sufficiently restrictive?
I mean, yes, we understand that it's a real rate that will matter and that it needs to be sufficiently restrictive. Again, I would say, sufficiently restrictive only when you see it. It's not something you can arrive at with confidence in a model or in various estimates, And so what are we seeing? We're seeing, through a combination of the unwinding of the pandemic-related demand and supply distortions and monetary policy's work in suppressing demand or alleviating very high demand. The combination of those two things is actually working. You're seeing, inflation coming down. It's principally now in goods, also in housing services. You begin to see effects of it in non-housing services as well. So we think that is working. And I think as we've said, we want to reach that. We want to reach something that we're confident it gets us to that level. And I think confidence comes from seeing, enough data that you feel like, yes, okay, this feels like we can for now decide that this is the right level and just agree to stay here. We're not permanently deciding not to go higher, but we would, let's say if we get to that level. And then the question is, how long do you stay at that level? And that's a whole nother set of questions. For now, the question is trying to find that level where we think we can stay there. And we haven't gotten to a point.
Man, they've been bad with this lag today, man. And this is not my end. You can see when it starts, it's still live.
That's the stage.
This year, and even then it seems possible that core PCE inflation could come in even lower than the median at 3.7%. Would you see a case to raise rates still if it turned out that you were going to achieve the same real rate this year because the decline in inflation proceeds somewhat better than you currently anticipate?
The decision that we make at each meeting, and certainly at the last two meetings this year, it's going to depend on the totality of all the data. So the inflation data, the labor market data, the growth data, the balance of risks and the other events that are happening out there. We take all of that into account. So I can't really answer a hypothetical about one piece of that. It'll be trying to reach a judgment over whether we should move forward with another rate hike overall, and whether that would increase our confidence that yes, this is an appropriate move, and it will help us be more confident that we've gotten to the level that we need to get to.
Yeah, so that's like CPI, PCE, PPI.
Thanks, Chair Powell. Following up on Nick's question, actually, John Williams, the New York Fed president, obviously has said things to the effect of next year, as we see inflation kind of, again, to Nick's point, as we see inflation coming down, we're going to need to reduce interest rates to make sure that we're not squeezing the economy harder and harder over time. And I wonder if that's basically the logic that you apply. Is that how you think about it? And then I also wonder, in the last press conference, you said something to the effect of, it's a full year out, those discussions, and people interpreted that to mean that you didn't see a possibility of a rate cut in the first half of next year. And I wonder if that was what you meant by that, or whether, how you're thinking about that timing.
No, when I answer these questions about hypotheticals about cutting, I'm never intending to send a signal about timing. I'm just answering them as the question is expressed. So please, I wouldn't want to be taken that way. Sorry, the first question was that how? Yeah, so we're as we go into next year, that's the question we'll be asking is, taking into account lags and everything else we know about the economy and everything we know about monetary policy. The time will come at some point, and I'm not saying when, that it's appropriate to cut. Part of that may be that real rates are rising because inflation is coming down. Part of it just may be that it'll be all the factors that we see in the economy. And, that time will certainly come at some point. And what you see is us writing down, a year ahead estimates of what that might be. And, there's so much uncertainty around that. When we, in the moment, we'll do what we think makes sense. No one will look back at this and say, hey, we made a plan. It's not like that at all. These are estimates made a year in advance that are highly uncertain. And that's how it is.
Neil.
Thanks so much, Chair Powell. Neil Irwin with Axios. Wonder, how do you think about the question of whether the strong GDP growth we've been seeing is driven by excess demand versus supply side factors, productivity, labor force growth? And relatedly, if GDP keeps coming in hot, even in the absence of inflation resurgence, would that on its own be a reason to consider more tightening?
So on your first question, I mean, we're looking at GDP very, very carefully to try to understand really what's the direction of it, what's driving it, and it's a lot of consumer spending. The consumer's been very robust in spending. So that is, that's how we're looking at it. Sorry, your second question was?
There's GDP stays hot, but without inflation.
So I think the question will be, GDP is not a mandate, right? Maximum employment and price stability are the mandates. The question will be, is GDP, is the heat that we see in GDP, is it really a threat to our ability to get back to 2% inflation? That's going to be the question. It's not a question about GDP on its own. It's you're expecting to see this improvement, continued rebalancing in the labor market and inflation moving back down to 2% in a sustainable way. We have to have confidence in that, and we'd be looking at GDP just to the extent that it threatens one or both of those.
Victoria.
Hi, Victoria Guida with Politico. There are multiple external factors that are playing out right now. We see rising oil prices. We see auto workers striking. There's the looming, very real possibility of a government shutdown. And I was just wondering, for each of those things, could you talk about how you're thinking about how that might affect the course for the Fed and the economy?
So there is a long list, and you hit some of them, but it's the strike, it's the government shutdown, resumption of student loan payments, higher long-term rates, oil price shock. There are a lot of things that you can look at. So what we try to do is assess all of them and handicap all of them. And ultimately, though, there's so much uncertainty around these things. I mean, to start with the strike, first of all, we absolutely don't comment on the strike, as we have no view on the strike one way or the other, but we do have to make an assessment of its economic effects to do our jobs. So, the thing about it is so uncertain. It will depend. The economic effects, it could affect, we've looked back at history, it could affect economic output, hiring, and inflation, but that's really going to depend on how broad it is and how long it's sustained for. And then it also depends on how quickly production can make up for lost production. So none of those things are known right now. It's very, very hard to know. So you just have to leave that uncertain and
Man, dude, what a weird day.
we'll be learning, I think, over the course of the next intermeeting period. It hasn't traditionally had much of a macroeconomic effect. Energy prices being higher, that is a significant thing. Energy prices being up can affect spending. It can affect over time. A sustained period of higher energy prices can affect consumer expectations about inflation. We tend to look through short-term volatility and look at core inflation. But so the question is, how long are higher prices sustained? We have to take those macroeconomic effects into account as well. Those are some of them. I'm not sure if I hit them all, but I mean, ultimately, you're coming into this with an economy that appears to have significant momentum, and that's what we start with. But we do have this collection of risks that you mentioned.
Greg Torres from Bloomberg News. I was a little surprised, Chair Powell, to hear you say that a soft landing is not a primary objective. This economy seeing added supply in a way that could create long-term inflation stability. We have prime age labor force participation moving up where people can add skills. Workers want to work. We have a boom in manufacturing construction. We've had a decent spate of home building. And since inflation's coming down with strong GDP growth, we may have higher productivity. All are which good for the Fed's longer run target of low inflation. And if we lose that in a recession, aren't we opting for the awful hysteresis that we had in 2010? So are you taking this into account as you pursue policy? Thank you.
To begin, a soft landing is a primary objective, and I did not say otherwise. I mean, that's what we've been trying to achieve for all this time. The real point, though, is the worst thing we can do is to fail to restore price stability, because the record is clear on that. If you don't restore price stability, inflation comes back, and you go through it, you can have a long period where the economy is just very uncertain, and it'll affect growth. It'll affect all kinds of things. It can be a miserable period to have inflation constantly coming back and the Fed coming in and having to tighten again and again. So the best thing we can do for everyone, we believe, is to restore price stability. I think now, today, we actually, we have the ability to be careful at this point and move carefully, and that's what we're planning to do. So we fully appreciate that, the benefits of being able to continue what we see already, which is rebalancing in the labor market and inflation coming down without seeing, an important, large increase in unemployment, which has been typical of other tightening cycles. So.
Hi, thank you. Chris Rugaber at Associated Press. When you look at the disinflation that has taken place so far, do you see it mostly as a result of what some economists are calling the low-hanging fruit, such as the unwinding of supply chain snarls and other pandemic disruptions, or is it more a broad disinflationary trend that involves most goods and services across the economy? Thank you.
So if I understood your question, I would say it this way. I think we knew from before when we lifted off, but certainly by the time we knew that bringing inflation back down was going to take, as I call it, the unwinding of these distortions to both supply and demand that happened because of the pandemic and the response. So that unwinding was going to be important. In addition, monetary policy was going to help. It was going to help supply side heal by cooling demand off, and just in general, a lot better aligning supply with demand. So those two forces were always going to be important. It's very hard to pull them apart. They work together. I do think both of them are at work now, and I think they're at work in a way that shows you the progress that we are seeing.
Michael McKee from Bloomberg Television and Radio. In June, you forecast a 5.
Man, I don't know what's up with their lag today, man. They have been lagging constantly all day. Their volume is bad today. Like, everything's just rough on their end.
What would justify that last move? Because the median forecast is for lower inflation. And given all the known unknowns that you face, how much confidence do you have, can investors have, or the American people have in your forecasts?
Well, forecasts are highly uncertain. Forecasting is very difficult. Forecasters are a humble lot with much to be humble about. But to get to your question, though, what's happened is growth has come in stronger, right? Stronger than expected. And that's required higher rates. Unemployment, you also see that the ultimate unemployment rate is not as high, but that's really because of what we've been seeing in the labor market. We've seen more and more progress in the labor market without seeing significantly higher unemployment. So we're continuing that trend. In terms of inflation, you are seeing the last 3 readings are very, very good readings. It's only 3 readings. We were well aware that we need to see more than 3 readings. But if you look at June, July, and August, you're looking at really significant declines in core inflation, largely in the goods sector, also to some extent in housing services, and just a little in non-housing services. Those are the 3 buckets. Headline inflation, of course, has come way down, largely due to lower energy prices, some of which is now reversing. So I think people should know that economic forecasting is very difficult, and these are highly uncertain forecasts. But These are our forecasts. We have very high quality people working on these forecasts, and I think they stand up well against other forecasters. But just the nature of the business is the economy is very difficult to forecast.
Given the forecast that you have, what justified not moving today, and what could justify moving in the future if you think?
Well, I think we have come very far, very fast in the rate increases that we've made. And I think it was important at the beginning that we moved quickly, and we did. And I think as we get closer to the rate that we think, the stance of monetary policy that we think is appropriate to bring inflation down to 2% over time, the risks become more two-sided. And the risk of over-tightening and the risk of under-tightening becomes more equal. And I think that the natural common sense thing to do is as you approach that, you move a little more slowly as you get closer to it. And that's what we're doing. So we're taking advantage of the fact that we have moved quickly to move a little more carefully now as we sort of find our way to the right level of restriction that we need to get inflation back down to 2%.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. With your focus on year-over-year PCE, isn't it true that base effects are huge and that by the time you meet in November, that it's more likely that you'll have a low PCE number that would make you feel more comfortable? And secondly, how would the lack of key indicators like CPI, the jobs report, impact your approach in upcoming meetings if we were to have a government shutdown? Thank you.
Yeah, I missed the first question. What was what factors?
The base factors.
Base factors. Okay. So on that, we're looking at just monthly, right? You can look at just monthly readings and see what the increase was from the prior month. So you're right. When you go back 3, 6, and 12 months, you get base factors, but we can adjust for that. In terms of not getting data, again, we don't comment on government shutdowns. It's possible if there is a government shutdown and it lasts through the next meeting, then it's possible we wouldn't be getting some of the data that we would ordinarily get, and we would just have to deal with that. And I don't know. It's hard for me to say in advance how that would affect that meeting. It would depend on all kinds of factors that I don't know about now, but it's certainly a reality that's a possibility.
As those kind of fall out of the equation for the next couple of readings by November, would you feel more comfortable at that point?
Yes. I mean, if you're looking, if we can tell how much inflation has gone up in a given month, right? And that's what we're looking at. And month by month, what's the reading? And I think what we're really looking at is there's a tendency to look at shorter and shorter maturities, but they're incredibly volatile and they can be misleading. That's why we look at 12-month. But I think in this situation where it looks like we've had a bit of a turn in inflation starting in June, we're also looking at 6 months and even 3 months, but really 6 months inflation. So you're looking at it over that period and over longer periods. That's the right way to go. And we don't need to be in a hurry in getting to a conclusion about what to do. We can let the data evolve.
Thanks for the question, Chair Powell. Edward Lawrence with Fox Business. So I want to focus back in on oil prices. We're seeing oil prices, as you mentioned, move up, and that's pushing the price of gas. So how does that factor into your decision to raise rates or not? Because the last two inflation reports, PCE and CPI, we've seen the overall inflation has actually risen.
Right. So, energy prices are very important for the consumer. This can affect consumer spending. It certainly can affect consumer sentiment. I mean, gas prices are one of the big things that affects consumer sentiment. It really comes down to how persistent, how sustained these energy prices are. The reason why we look at core inflation, which excludes food and energy, is that energy goes up and down like that. And it doesn't, energy prices mostly don't contain much of a signal about how tight the economy is, and hence don't tell you much about where inflation's really going. However, we're well aware, though, that if energy prices increase and stay high, that'll have an effect on spending, and it may have an effect on consumer expectations of inflation, things like that. That's just things we have to monitor. So,
Oh, yeah, on the consumer, they're putting more and more of this on their credit card. The consumer seeing, record credit spending. How long do you think the consumer can manage that debt at higher interest rates now? And are you concerned about a debt bubble related to that?
So to finish my prior thought, I was saying that's why we tend to look through energy moves that we can see as short-term volatility. Turning to consumer credit, of course, we watch that carefully. Consumer distress, measures of distress among consumers were at historic lows quite recently, during and after the pandemic. They're now moving back up to normal. We're watching that carefully. But at this point, these readings they're not at troublingly high levels. They're just kind of moving back up to what was typical in the pre-pandemic era.
Hi, Jean Young with M&I Market News. Yields along the Treasury curve have risen to their highest in years. What is the Fed's view about what's been driving that increase in recent weeks, and how much of it can be attributed to macro explanations and how much to technical factors?
So you're right. Rates have moved up significantly. I think it's always hard to say precisely, but most people do a common decomposition of the increase, and the view will be it's not mostly about inflation expectations. It's mostly about other things, either term premium or real yields, and it's hard to be precise about this. Of course, everyone's got models that'll give you a very precise answer, but they give you different answers. So, but essentially, they're moving up because it's not because of inflation. It's because it'll probably have something to do with stronger growth. I would say more supply of treasuries. The common explanations that you hear in the markets kind of make sense.
Kyle Campbell, American Banker. Thank you for taking the questions. Just two on housing. You said slower shelter cost growth is in the pipeline and will reflect in inflation readings as new leases are signed. But there's also some questions out there about the way housing costs are measured, particularly the use of rental equivalents, which are estimates from homeowners about what their homes would rent for if they were in the rental market. So my question is, how much of the effort to tame inflation, both as it's measured and felt by the broader public, hinges on housing supply? And then as far as a constrained housing supply being sort of exacerbated by this sort of lock-in effect of mortgages being higher now than they were at their recent historic lows, how is that going to impact future thinking about taking interest rates to that lower bound in the future?
So on the supply point, of course, supply is very important over time in setting house prices and for that matter, rents. And supply is kind of structurally constrained. But in terms of where inflation is going in the near term, though, as you obviously know, a lot of it is leases that are running off and then being re-signed or released at a level that's it won't be that much higher. A year ago it would have been much higher than it was a year before. Now it may be below or at the same level. So as those leases are rolling over, we're seeing what we expect, which is measured housing services inflation coming down. Your second question was the lock-ins. How much is that affecting things, really?
Is that going to affect your decisions to potentially bring rates down to their lower bound in the future, sort of creating that sort of bubble of buying and then a lock-in that sort of stagnates the housing market?
I think we look at I would look at the lock-in, the idea being that people are in very low rate mortgages. And even if they want to move now, it would be hard because the new mortgage would be so expensive. Play a role in our future decisions in a future loosening cycle about whether we would cut rates? No, I don't think it would. I mean, I don't think that's. I think we'd be looking at what fundamentally what rates does the economy need, and in an emergency like the pandemic or during the global financial crisis, you have to cut rates to the point that you have to do what you can to support the economy. So I wouldn't think that would be a reason for us not to do that. It's not something we're thinking about at all right now, but down the road, I wouldn't think so.
Hi, Nancy Marshall-Genzer with Marketplace. Chair Powell, you've mentioned several things that would possibly weigh on consumer confidence, maybe cut back consumer spending, possible government shutdown, high gas prices. At this point, would the Fed welcome a decrease in consumer spending? Would that help you get inflation closer to your 2% target?
I wouldn't say it that way. We're not looking for a decrease in consumer spending. It's a good thing that the economy is strong. It's a good thing that the economy has been able to hold up under the tightening that we've done. It's a good thing that the labor market's strong. The only concern, and it just means this: if the economy comes in stronger than expected, that just means we'll have to do more in terms of monetary policy to get back to 2%, because we will get back to 2%. Does that answer your question?
Yeah, and I guess on the other hand, would you worry that that could contribute to an economic slowdown or even a recession?
Well, that's always a concern. I mean, concern number one is restoring price stability, because in the long run, that's something we have to do so that we can have the kind of economy we really want, which is one with sustained period of tight labor market conditions that benefit all, as I've said a couple times. So that said, of course, we also now, given how far we've come with our rate hikes and how quickly we've come here, we do have the ability to be careful as we move forward because of that consideration.
Thank you, Chair Powell. Simon Rabinovich with The Economist. One of the factors in the economic resilience to date appears to be a lesser degree of rate sensitivity than in the past. Obviously, we've talked about households with long fixed rate mortgages, also companies that refinanced before last year. What is your thinking about the efficacy of rates and how that's changed? And then related to that, how do you think about the distributional consequences, in the sense that if you're a relatively wealthy household with a long fixed rate mortgage, the past year has not been all that tough with rates going up. Whereas if you're relying on your credit card for supporting your consumption, in fact, times are getting a lot tougher, a lot more quickly. Thanks.
So I guess it's fair to say that the economy has been stronger than many expected, given what's been happening with interest rates. Why is that? Many candidate explanations. Possibly a number of them make sense. One is just that household balance sheets and business balance sheets have been stronger than we had understood, and so that's spending is held up and that kind of thing. We're not sure about that. The savings rate for consumers has come down a lot. The question is whether that's sustainable. It could just mean that the date of effect is later. It could also be that for other reasons, the neutral rate of interest is higher for various reasons. We don't know that. It could also just be that policy hasn't been restrictive enough for long enough. And there are many candidate explanations. We have to, in all this uncertainty, make policy. And I feel like what we have right now is what's still a very strong labor market, but that's coming back into balance. We were making progress on inflation.
See, this is
By
them.
many forecasts,
See, look, that's them.
Many forecasts call for growth to moderate over the course of the next year. So that's where we are, and we have to deal with what comes. On your second question your second question was distributional, but can you be a little clearer about that?
Yeah, my point there was that if you're somebody who has a long fixed rate mortgage, you've been able to endure the higher rates relatively easily. If you're somebody who's living month to month off of your credit card, current financing rates are punitive.
Yes. And so the point I would make there is that we're trying to get inflation back down. The people who are most hurt by inflation are the people who are on a fixed income. If you're a person who spends all of your income, you don't really have any meaningful savings. You spend all your income on the basics of life: clothing, food, transportation, heating, the basics. And prices go up by 5, 6, 7%. You're in trouble right away. Whereas even middle class people have some savings and some ability to absorb that. So it is for those people as much as for anybody, that we need to restore price stability. And we want to do it as quickly as possible. Obviously, we would like to do that. We'd like the current trend to continue, which is that we're making progress without seeing the kind of increase in unemployment that we've seen in past things. But you're right, though. When we raise rates, people who are, who are living on credit cards and borrowing are going to feel that more. They are. And of course, people with lots of savings also have a much lower marginal propensity to consume, and so it's not going to affect them as much.
Let's go to Greg Robb for the last question.
Last question.
Thank you, Chair Powell. Greg Robb from MarketWatch. In the Beige Book recently, you can tell that the Fed has been surveying nonprofits and community groups about the economic health of low-income Americans, moderate-income Americans. I have two questions about this. Are you going to use that data to maybe come up with sort of like a quarterly survey of those groups, like the Senior Loan Officer Survey? And and also the second question is, from your recent readings of these surveys, how are low and moderate Americans doing? Is there this thing where like the GDP is strong because of wealthy Americans kind of driving things? I just want to get your sense of the health of that sector. Thank you.
So I don't know about the quarterly survey. That's an idea we can take away and think about. In terms of how low and moderate Americans, they're clearly we're suffering from high inflation. I think during the pandemic, the government transfers that happened were very meaningful. And if the surveys that we take showed that low and moderate income people were actually in very, very strong financial condition. I think now it's a very hot labor market, and you're seeing high nominal wages, and you're starting to see real wages are now positive by most measures. So I think overall households are in good shape. Surveys are a different thing. So surveys are showing dissatisfaction, and I think a lot of that is just people hate inflation, hate it. And that causes people to say the economy is terrible, but at the same time, they're spending money. Their behavior is not exactly what you would expect from the surveys. That's kind of a guess at what the answer might be. But I think there's a lot of good things happening on household balance sheets, and certainly in the labor market and with wages. The biggest wage increases having gone to relatively low wage jobs, and now inflation coming down, you're seeing real wages, which is a good thing. Thanks very much.
All right, that's Big Papa Powell. He's heading out now. That is it for today. Let me know what you guys think, guys. Again, that is Powell today. The market has definitely negative reacted to this. There's the NASDAQ. We're not even, again, people are being dramatic, acting like it's the end of the world, like we get on every major economic report. What I heard mostly from this report is that he's pretty neutral. He doesn't really want to make any definitive statements. He doesn't really want to say, yeah, we are going to pause for the rest of the year. He doesn't want to say we're going to raise again this year. He doesn't want to say we are going to hit a recession next year. He doesn't want to say we're not going to hit a recession next year. Overall, it was pretty neutral. The market definitely reacted somewhat bearishly, but again, we're not super low. SPY still over 440s, still over the last few weeks' lows. Like, it's not the end of the world. And right now, it's pretty choppy. Tomorrow, we do have jobless claims and durable good orders. Next week, we got a bunch of stuff going down. And then earnings season starts again in October. So again, let me know what you guys think we're going to get. And with that said, hit the like button, hit the subscribe button. If you haven't already, hit the notification bell. Help me break 115,000 subs. We're actually pretty close to breaking 115,000 subs, guys. Let me see where we're at. We are at... And again, they were laggy, bro. It was a choppy stream. Oh, we need 100 subs right now. We got 2,500 people here. Listen, we cover all these major economic releases. We cover all the FOMC meetings. Jobless claims report tomorrow. We'll be streaming live. CPI, PPI, Jerome Powell press conferences. We cover all of it, interpret all of it. We're pretty neutral on everything. We don't sell a course. We don't act like experts. My goal is just to help new traders and help traders in general. And the reason we get thousands of people here because we're reliable and we cover the data quick. And so you can either pay $30K for Bloomberg Terminal or you can subscribe to Beginner Trading for free. So hit the subscribe button. I appreciate the love and support. Again, if you want to check out our sponsors, again, I'm biased in both of their favor because they pay me money, but they're useful. If you want to day trade with No PDT rule. Try out futures. And the cheapest way to try out futures is a funded account program. Top Step's the most legit one in the world. They pay out millions in actual withdrawals every year. They fund thousands of traders a year. In the S&P, in the futures market, you can day trade the NASDAQ and what's called the NQ. You can day trade the SPY and what's called the E-mini. You can day trade gold, currencies, all that good stuff with no PDT rule. And they give you a demo. They test your skill. It's only $49 for the base one. If you can pass their testing, they fund you between $50,000 all the way up to over 100K with a 90% split once you're funded. And so it's the best of both worlds, in my opinion, where if you lose, you're only out $49. If you're good enough to pass it, you get 90% anyway once you're funded. And so, limited risk, similar reward to putting up the money yourself with just less risk. And I think just taking this challenge builds your skill if you want to get good at day trading. Most pro day traders trade futures. But again, I am biased in their favor. You can check out the link right here. Also, if you want to check out my other sponsor, Chart Prime is doing a $1 trial right now. For just $1, you can try them out for 2 weeks on Chart Prime right now. So if you ever wanted to try out Chart Prime, it's a trading view indicator service. Again, you can use it in stocks, crypto, Forex, futures. They give you custom trading view alerts. Again, it's very cheap to try them out. Again, it costs $1. After that, it's $40 a month, I believe, for Chart Prime. And again, just genuinely useful. If you want to check it out, I showed this earlier. Again, really nice breakdowns. I like using the regular market oracle where you can kind of go like this and see regular market oracle. You see reversals. I like to put up the chart patterns as well. So you can see like flag patterns, wedges, trends, all that good stuff. Look at this rising wedge trend. Look at the sell signal here and then really nice drops. The strong signals are really powerful. Look, strong buy signal here. Really nice bounce, buy signal here, bounce, sell signal here, drop. And that's just a small piece. There's smart money concepts, oscillators, regular reversal symbols, market dynamics, all this good stuff here. And it's like $40 a month. And again, you can try it out for $1 right now. $1. Here, check it out. There's the link right there. I love you all. I'll be safe tomorrow. Again, tomorrow we have jobless claims numbers coming out. Really important release, especially after today. And again, jobless claims is basically how many people are filing for unemployment. So jobless claims is how many people filing for unemployment. It drops tomorrow at 8:30 Eastern Standard Time, and we will be streaming that data live as it happens, like we always do. Again, we're mostly an economic report channel here at Beginner Trading. So if you appreciate the love, hit the subscribe button, hit the like button. Yeah, we heard you, Jason. Good day to you, sir. I appreciate the love, guys. Thanks so much. And yeah, I'll see you guys later. Y'all be safe. Let me see how many subs we got. I just want to see. Oh, listen, we need 45 subs. Listen. Don't make me beg here, guys. Don't make me beg. We need 45 subs. That's all we need. Just listen. I would never pressure you to subscribe, but if you don't, I'll hate you forever. Okay? You can follow along with our streams. Again, we really do cover all the major economic reports, all the economic data, all that good stuff. Again, just to recap what the Fed said today. Okay? So the Fed chose to pause or skip raising rates. So the Fed chose not to raise rates to keep the federal funds rate where it was between 5.25 and 5.5. Again, that was what was expected, and so that's basically a neutral reading. And so what we didn't then turn to was what Jerome Powell said during the actual interview, and what he said during the Q&A in the interview was pretty neutral. He was very hesitant and apprehensive to give definitive statements and answers. They asked him about potential recession fears, whether he thinks we would accomplish a soft landing. He said he didn't know. They asked him if he if they were going to raise rates this year. He said they didn't know. So very neutral responses here. The market has slightly reacted negatively to it. It's definitely down from this, but it's not a huge drop relative to other FOMC meetings, to other economic releases. And so pretty neutral responses altogether. Let me know what you guys think the market is going to do over the next 6 weeks. And again, hit the subscribe button, hit the like button. We cover all this stuff live for free as it happens. Again, we'll see what inflation shows up as. Inflation is going to drop early next month. Next week, we have PCE data and I believe unemployment data as well. So we do have some economic reports coming out. And tomorrow we have jobless claims. And so I'll see you guys then. Y'all be safe. And yeah, appreciate the love, guys. Let's see if we hit it or not. Again, regardless of whether we hit it, I'm going to close it down and we'll hit it tomorrow. We need 25 subs. Listen, we still got 1,400. Do it now. Subscribe. But no, I appreciate the love. Let me edit this real quick so I can create a short from the content. And again, let me know what you guys think of this meeting. Again, we definitely had a negative reaction. We can take a look at the short from the content. And again, let me know what you guys think. Sorry, let me mute that. So let me take a look at the S&P 500 futures contract here. See if it looks any better. Yeah, it doesn't look much better than the NASDAQ. Still definitely down. Yeah. Again, not the worst reaction. Definitely not a good reaction, though. All right, so yeah, the Fed chose to pause or skip raising rates. They did not raise rates. We don't know whether it's a pause or a skip. If it's a skip, that means that we'll go back to raising rates in November. If it's a pause, that means we'll sustain that plan, extended past the next cycle. But again, they chose to pause or skip. And then again, what he said during the actual conference was pretty neutral. Let me know if you guys think it was as well. I'll see you guys tomorrow bright and early at 8:30. We get jobless claims. And I think, let me see, tomorrow we get jobless claims and okay, so tomorrow we get jobless claims in the Philly Fed Index, as well as existing home sales at 10. And again, we'll stream the entire thing live as it happens, guys. So I'll see you guys there. Good luck. Y'all be safe. Love you all. See you guys tomorrow.